Three. Good evening, everyone. We are Group 2 Carbon Biking. Tonight, we'll be presenting an overview of our company's performance throughout the marketplace simulation. We'll highlight our strategy, key results, major challenges, and what we learned from the decisions we made along the way.
Our executive summary. Some of our major accomplishments were that we were the number one performing company in the simulation. We also had a 12.15 million revenue in Q6 and a 2.57 million net income, as well as a 2.666 million cash with zero debt. Our biggest challenges, however, were in HR management and future investment and manufacturing productivity below average. The final outcome was that we finished at the top overall as its overall top performer with strong profitability and profitability and financial stability. Our key takeaway was our strong growth and marketing drove success. Our future focus should be on employees, innovation, and productivity. Next slide.
So our overall corporate strategy focus on growth through global expansion, product differentiation, innovation, and continuous improvement. As the simulation progressed, we used quarterly results to adjust our decisions rather than staying locked into our original plan. We placed greater emphasis on the mountain and speed segments while continuing to expand our market presence. And as our company grew, we had to balance investments in manufacturing, marketing, research and development, and our workforce. Growth required trade-offs, so our goal was to invest in areas that supported our long-term direction while maintaining financial and operational discipline. So overall, our strategy remained flexible and focused on strengthening our competitive position and creating long-term shareholder value. So this slide, it shows some of the research and development investments that supported our product strategy. We invested in features such as enriched carbon fiber, super traction mountain tires, racing tires, carbon ceramic disc brakes, improved handlebars, and 11-speed gearing. These improvements supported our mountain and speed products and helped differentiate our brands. We also had other R&D opportunities available, but each required additional investments because of that, we had to determine which projects provided the greatest value. Our approach was to invest selectively in innovations that supported our target markets and long-term strategy rather than simply purchasing available upgrade. On top of what Ashley mentioned about our overall performance, these trophies show how our strategy translated into specific results. We are the Champions Trophy for having the highest cumulative balance scorecard. Congrats, everyone. We also earned We Are Global after expanding into all world regions, which supports our global expansion strategy. And our final Top Demand Trophy, it shows that we generated the highest demand with a single customer segment compared with our competitors. Together, these achievements reflect strong overall performance, broader market reach, and customer demand. And next slide.
So for our marketing performance over the Q4 to Q6 quarters, Carbon Biking took the market share in speed and mountain segments. In Q3, we had a 23% market share in the speed segment, but in Q4, we jumped up to 31% of the market segment. In Q3, we had 18% of the mountain bike segment, and in Q4, we jumped up to 25%. In Q5, the world economy expanded by 3%. Carbon fiber, standard carbon fiber became outdated and dangerous. And so because we had made investments in Q4 to roll out carbon fiber, enriched carbon fiber, that took effect in our Q5. So it didn't affect any of our sales and it actually added to our brands. So yeah, in Q5, we took the market share of 31%. Total demand was at 5,756 entering Q6. Our ads, Terrain Terror for the Trekker 4, took top ad judgment in Q5 at 90. The new speed brand Vortex took the top brand judgment of 88. And our new recreation brand, Joyride 2, took top brand judgment of 83 in Q5. So Q6 business growth was projected to be 4% greater in the US and European markets. So we took our brands, well, those were our top two markets already. We were already in New York and Amsterdam. And so we further expanded by adding around 9 brands into our market during Q5 and Q6. Next slide. So our market orientation and strategic growth. Our market orientation, our value-driven markets were maintaining mountain and speed segments. So in Q4, we had 5 brands and 2 new brands were added that quarter. We sold 1,474 units and we grossed $1.38 million that quarter. In Q5, we were still focused on mountain and speed. We had 9 brands for sale and 3 new brands were added into the market that quarter. We sold 5,278 units in Q5 and we grossed $4.61 million. And then in Q6, our mountains, we actually opened up to all market segments, mountain speed and recreation. We maintained 9 brands, but we added 4 new brands within each of those segments. We sold 9,268 units and we grossed $7.82 million. Our long-term strategic thrust was incremental expansion. We started slow with limited brands starting out the simulation, and by the end, we had increased this number to 9 brands. Our advertising spend from Q4 was $50,310, but we ended Q6 spending $579,242. So we invested a lot of money in our advertising spend across all of the 9 brands that we were promoting. And then our internet market went up from Q4 of $24,000 to $188,000 in Q6. As a market leader, we went from a follower that was looking kind of at how everyone else was playing the simulation, and we eventually took market lead and became the top team in the marketplace and earning ourselves a 28% market share. Next slide. So our strategic plan and achievements, our mission statement was to build the perfect carbon bike for every customer. So deferring to our core business plan, we were cautiously expanding and managing growth. We maintained a cautious willingness to take risks. We introduced new brands gradually. We were seeing how the market was moving, which brands were doing good, and we took a backseat position and saw what other brands were doing right, and we copied them and did it better. Our marketing spend increased with our ability to manufacture more units over the 6 quarters. Segmentation and incremental moves. By Q6, we had introduced our recreation as our third major priority, with the Joyride 2 and Sun Chaser being some of our most profitable bikes that we were selling. We moved incrementally, as I said, and between Q4 and Q6, we ramped up our marketing. We increased our ad spend, our social media spending, and our research and design investments. Next.
Okay, on this table is basically showing well, more my teammates talked before. On this table, I want to point it out to the demand sales per person. You can see that on the white rows are the projected numbers. On the light blue are the real numbers that we got from the market. You can see on Q4 that we were projecting demand per salesperson on 126, and we got like 78. On Q5, we were expecting 155, and we got 240. it was a substantial increment on the demand per salesperson. And on Q6, we were expecting 250 and we got 367. This is basically due to a different situations that we have previously and the way that we program and projected our investments and our projected demand. Let's go to the next slide. This is what basically it was told before that Q4 and Q5 we were on the three major cities that we have more expectations to sell more. And you can see how what it says the uh, total sales and service people, how we were the distributions of sell people per store per city. It was different on each quarter. By quarter 6, we have New York at the top with 12 salespersons, Amsterdam 8, and the rest it was 4 and 4. At this point on Q6, we already have a Rio de Janeiro. And you can see that with more expertise becomes better decisions and better investments. And this is going to help us a lot on our results. Let's go to the next slide. This was one of our top decisions where we base our tactics and strategies. You can see that on Q4 we had basically this is not all the brands that we had on Q4. It's just a couple of them that we carry up to the quarter 6. But you can see how Zoom 2 brand revenue, the first row, it says Zoom 2 it was making on the revenues almost $900,000. Zoom 3, it was almost $400,000. The more important thing in here it is that the profit per unit, you can see that the Zoom 2, it was almost 900 per unit. That means that this bike, it was very profitable. Zoom 3, it was on 700. That was really good. So we try to keep the ones that were making the most money out of every bike. And you can see that we carry those two brands to quarter 5 and even to quarter 6. By quarter 6, you can see that Zoom 3 was making $900 per unit. Even though it was not the best-selling bike, it was still making really good profit out of that bike. And you can see as well on this table how when it says brand revenue per quarter, you can see on quarter 4 on Zoom 3 we got almost $400,000. On quarter 5 we got like $300,000. By the quarter 6, most of the brands were making really good money. Most of them we were making, for example, on Joyride 2, it was 1 million. If we jump to Vortex, it was 2 million. Trekker 4, it was 1 million. Ranger, it was 2 million, and so on. You can see that we were selling by millions at that point. We got a lot of expertise planning, designing, and marketing our brand. And that was giving us the results that we get at the very end. Let's go to the next one, please. This one is one of the most important ones. On quarter 4, we didn't have a lot of uh, fixed capacity. So what we did, instead of trying to sell a lot, we invested a lot on RD and marketing. That was our priority. Well, marketing was not that much on that quarter, but it was mostly R&D. As I was mentioned before, a better um, carbon material for the bikes, better tires, and we invested a lot on fixed capacity. And you can see that on the rest of the quarters, we were investing a little bit more smarter. We needed to invest less because we pay upfront with most of our investment on quarter 4. Let's go to the next one. You can see on this slide how on the left side we have our investments per quarter, and on the right side we're going to have our demand per salesperson. the projected one and the actual real one. You can see on the demand per salesperson on quarter 4, it was, or the real one was lower than the projected one because at that point we were investing a lot on the future to go ahead and make more money out of the next quarters. You can see on quarter 5 how the projected fell short, and quarter 6 it fell even shorter. We were making a lot of sales because we were investing more on marketing than before. Let's go to the next slide, please. And this one is about the same. You can see that on quarter 4 this is the total demand, the projected one versus the real one. You can see that on quarter 5 we did very well. Our projections were short. We actually had a huge demand. It was so high that you can see that our operational production was shorter than our demand, so we have a small stock out. And on quarter 6, it was the same. Our demand was almost 12,000 bikes, which one we could just produce 9,000, so we had a small stock out. We were doing so great because our investments were paying out from what we did from quarter 4. Next slide, please. And just a comparison with the other competitors, you can see on the left side how the total demand it was basically almost the same for everyone. You can see that they were very close on 9,000 by quarter 6 on the next competitor. But on the right side, you can see the number of units sold. You can see how short they fell. That is because they could not produce what they're selling. They had a lot of stockouts, something that we didn't have because we were projecting and managing better our production hand by hand with marketing, investment, and production. Let's go to the next slide.
We can't hear you, Violetta. Your mic is off.
Sorry. Manufacturing performance quarter 4 to 6. Our manufacturing actions were generally aligned with the business plan. We maintain a appropriate capacity, adjusted production schedule according to demand, control overtime and costs, and focus on improving worker productivity and product quality. These actions, do you listen? These actions help us customer demand while improving manufacturing efficiency and reducing unnecessary production costs. The departures from the business plan were necessary to the change in the demand and the manufacturing efficiency. We had the original plan, but the production decisions were adjusted to the balanced customer demand, inventory levels, overtime costs, and productivity. The adjustments helped the company respond to short-term operational challenges while avoiding necessary investment and additional capacity. The next, please. Changes in customer demand require us continuously adjust our production schedule to avoid both shortage and excess inventory. Worker productivity was also an important factor because the estimated productivity level reduced the actual number of bikes that could be produced compared with theoretical capacity. As a result, we had to be careful to manage production capacity and consider overtime when necessary to meet market demand. In addition, our production and inventory decisions affect manufacturing costs and our ability to satisfy customers. Overall, the experience from quarters 4 to 6 showed that successful manufacturing performance depends on balanced demand forecast, worker productivity, capacity utilization, overtime, and inventory rather than simply maximizing production. This adjustment helped the company become more responsive to market conditions and better aligning production with customer demand. Next, please. Our manufacturing performance show progress toward our key performance goal. In Q4, performance indicators were below expectations because production efficiency and schedule were still being adjusted to match demand. During Q5 to 6, improving worker productivity, production schedule, capacity, utilization, and product quality, helping the company move closer to achieve its target. By Q6, manufacturing performance was more efficient and better alignment with the customers' demand, while overtime and production costs were managed more effectively. Next, please.
So for our human resources, our strategy during quarters 4 through 6 focus on supporting company growth while maintaining a productive and competitive workforce. Our priorities included competitive compensation, stronger benefits, employee development, expanding the sales force, and continuing professional training in sales contests. As the simulation progressed, we adjust these decisions based on employee performance, competitive benchmarks, and company needs. Our goal was not simply to spend more on employees, but to make targeted investments that could improve productivity, satisfaction, and retention while controlling labor costs. So for this slide, one of the biggest areas we adjusted was employee compensation. In quarter 5, production worker salaries increased to 13,000, production supervisors to 17,000, and the sales force to 20,000. In quarter 6, salaries increased again to 13,500 for production workers, 17,500 for supervisors, and 22,000 for the sales force. We also strengthened benefits in areas such as health coverage, vacation, pension, and contributions. These decisions were based partly on competitor information. We wanted to remain competitive without automatically becoming the highest paying company in every category. Our goal was to improve employee satisfaction and productivity while still controlling our labor costs. As the company expanded, we also increased our sales and service workforce. By quarter 6, we had 28 employees in this area. We continued investing in professional training at 1,200 per employee, and sales contests at 1,000 per employee. These programs were intended to improve the productivity of our existing workforce rather than relying only on additional hiring. We also monitored employees' morale and industry comparisons by quarter 6. By quarter 6, employee morale increased to 84. And while our final human resource management score reached 8.88. And overall, our HR decisions remain consistent with our original business plan, but we adjusted compensation, benefits, staffing, and training as new information became available. Our goal throughout was to support company growth while balancing employee satisfaction, productivity, and labor costs.
So our financial performance for Q4 through Q6. So first, to begin with, our actions taken versus the plan. We focused on market growth, profitability, and expansion. We increased our investments in R&D, advertising quality, and system improvements. We expanded production capacity to support rising demand and maintained a debt-free financing strategy. We also plan to increase sales force and digital marketing support as sales grew. On the right, you can see a snapshot of our income statement that I think does a great job of demonstrating the impact of our strategy. Because you can see that even with our investment in R&D, marketing, quality, and operations, we finished the quarter with a 12.15 million in revenue and a 2.57 million in net income, which shows that our adjustments to the original plan produced strong results. Departures from the plan where spending increased significantly as market opportunities developed. Additional production capacity was added to support rapid sales growth. Marketing and R&D investments were adjusted based on competitive results rather than kept in the initial levels. These changes were justified by strong demand and the need to maintain market position. The result of the plan and the things that we adjusted were to help was what helped us reach the 12.15 million in revenue and then the 2.57 million in net income. Next slide, please. So in continuation of our financial performance, some of the significant events included that in the early on quarters, we had losses because of the investments that we've had made. Then revenue increased substantially, reaching the 12.15 that I had mentioned earlier. Then Q6 operating cash flow reached 2.72 million. And we finished Q6 with a 2.66 million cash and no debt. Our KPI performance, so we were on there's a snapshot of our cumulative balance scorecard on the right side where you can see that we were number one on cumulative overall performance at 33.460. We led in financial and market performance. We also had strong marketing effectiveness, wealth and asset management. Reputation finished near the highest competitor level. The areas that we could improve were investment in the future, where you can see it was at 4.159, and also our HR management that was at 0.775. Our manufacturing productivity at 0.644. So our next priority were to maintain financial and market strength while improving employees and innovation and production efficiency. Next slide.
Basically, this slide just shows how our performance was done through quarter 4 to 6. You can see the growing trending on each of the metrics. The first one is the cumulative scorecard, where we went almost off the chart. But you can see the tendency to grow on every quarter. Let's go to the next slide. On this one is basically the conscious scorecard. You can see that the top one is Sony Cycles, and we are ranked on right at the middle with 57. So we are, basically average. But let's compare this to our top scorecard. Let's go to the next one, please. When you compare that our cumulative total performance is 33, we're at the top with a good conscious scorecard. Is the perfect balance between the top result against the conscious investments. You can see that the top investor, that it was Sony Cycles, the cumulative total performance is very low. That means that it's not a balance. How good can be that they can invest on conscious, unconscious scorecard, but they can hold it on long term. We are the perfect balance between success and conscious scorecard. So our performance is basically really good. Next one, please.
Future competitive strategy. Competitive advantage Our competitive advantage are based on operational efficiency, reliable products, and the ability to respond quickly to market change. A strong customer relationship, consistent performance, and responsive service help build customers' loyalty and repeat business. By focusing on innovation, continuous improvement, and sustainable practice, we can maintain a strong position and support long-term growth. Next, please. Future competitive strategy. We have planned improvements and future strategic priorities We finally invest in our employees, technology, and practice to build long-term growth to create value for all stakeholders. Next, please.
So as a group, the lessons we learned as part of the simulation, we learned to maintain constant communication. We saw what brands were successful and what areas needed improvement. And we learned to maintain a balanced scorecard to produce value for our stakeholders and shareholders. In a real world business situation, we learned the importance of team meetings to maintain our focus on our company's goals. We learned to make split decisions based on previous quarter data. And we learned the benefit of assigning each team member to a specific department, allowing them to gain mastery in each. And that is it.
Thank you, everyone.
Thank you, everyone.